Ermias Shatu. I'm the CEO of FSD Ethiopia. So thank you so much for coming this morning. Such a pleasure and honor to have you all here this morning. We have a very interesting session lined up for you, launching the Ethiopian climate report. That will be the topic of our discussion. For that, Rajashree Padmanabhi will be presenting the discussion points and the findings from the climate report.
So the work that I'm going to present today is part of a broader series of publications that we did to understand the overall climate finance ecosystem in Africa. So CPI undertook a first of its kind study to establish a baseline of climate finance flows in Africa. Throughout the year, last year in 2022, we released several pieces of work which looked at what are the climate finance needs in Africa, what is currently flowing, and as well as a framework for innovative solutions to mobilize climate finance. We also engaged in 3 country deep dives for Ethiopia, Nigeria, and Burkina Faso, as you can see on the screen. Ethiopia is one of the fastest growing countries in Africa and in the world. It is also one of the countries that contributed the least to global climate change, but it is one of the most vulnerable to its impacts. And therefore, this was a very important piece of work for us. And I will be presenting the findings today. The aim of the study was to establish a baseline based on available data, secondary data, and some interviews. And the aim is to inform investors and policymakers on solutions to scale up climate finance. And especially in countries like Africa, where we know the climate financing gap is huge and it will have massive impact on increasing the climate vulnerability of the country in the coming decades. So please feel free to note down your comments or questions as I go through the presentation, and I will try my best to respond to the best of my ability after the presentation. So the agenda for today is that I will be briefly introduce climate finance to you, some basic concepts of climate finance. I'll give an overview of the Africa-wide study that we did, and then deep dive into some case study findings for Ethiopia specifically, and also learnings from other peer countries that Ethiopia can learn. So let's start with what is climate finance first. What do we mean by climate finance? At the most basic level, climate finance refers to all financing that goes towards addressing climate mitigation and adaptation across sectors. So climate finance is needed for mitigation because we need large scale investments in reducing the greenhouse gas emissions that cause climate change. And it is also equally important for adaptation so that we can adapt to the adverse impacts of climate change in the coming decades. So where does climate finance come from? It can come from a variety of sources. It can come from local, national, and international sources of financing. It can be drawn from both public and private and any other alternative sources. So the landmark Paris Agreement for climate finance in 2015 reaffirmed the obligations of the developed countries to take the lead in mobilizing climate finance. But it also, for the first time, encouraged contributions by other countries and private financiers. So the global climate finance architecture has become extremely complex in the recent years. But at the very high level, it includes financing from public financiers at national, bilateral, and multilateral level. For example, multilateral development banks, funds that are set up by UNFCCC, and also bilateral and national development banks. And at the private level, it can encompass players from the capital market. So it can encompass businesses, corporations, institutional investors like pension funds, insurance, and even asset managers and their in equity, bond, and real estate and other asset classes. So it's basically a very comprehensive climate finance architecture that we see globally, and all of these sources contribute to climate finance. Uh, so, what is CPI's landscape of climate finance? What you see on the screen here is our classic spaghetti diagram, or a classic Sankey diagram, as we call it, and it is the snapshot of most recent 2021 estimates of annual climate finance flows globally, which amounted to about 653 billion. So this diagram may overwhelm you, but there's nothing to worry about it. It's basically just telling us on the left-hand column what are the sources of climate finance. So you can see governments, national banks, multilateral banks. In the middle column, you can see instruments like grants, debt, equity that are being used to channelize climate finance. And at the end, on the right side, it is showing us sectors and uses like adaptation, and sectors like water, wastewater, buildings, energy system, which are basically receiving this climate finance. So this is the kind of analysis that we do at CPI. We started doing this back in 2011, and we have improved and refined our methodology over time. And this is what we did for Africa and Ethiopia as well. Just quickly, on the other side of climate finance flows is the climate finance need. We basically need to contextualize the climate finance flows and understand where we need to reach and what are the targets we need to set. So fundamentally, it is all the cost that is needed to implement the nationally determined contribution of the countries that they have submitted to the UN as part of the Paris Agreement. And needs are basically, if the costs are X, then the needs are the amount of finance that the country needs to access from international sources. So we will minus the finance that the countries can mobilize on their own, and we will get the needs from international sources. And it is very difficult to at the moment to assess these needs because they are very country specific, and they usually vary based on country context and assumptions used in the scenario building, such as what is the economic growth of the country, what is going to be the population in the coming decade, and other financial variables. So, what we did was we basically looked at various NDC submissions from countries to the UNFCCC and did a bottom-up assessment of climate finance needs. And it comes as no surprise that in Africa, the climate finance needs are falling, climate finance flows are falling way short of its needs. During this decisive decade from 2020 to 2030, our analysis estimates that Africa needs roughly $2.8 trillion or $280 billion annually to implement its own NDCs and meet the 2030 climate goals. But on the contrary, our analysis shows that the annual climate finance flows stand only at 30 billion. So we have to go from 30 billion to 280 billion, which is at least a 9 times growth. And the time is of essence because if we don't act early, the cost of climate change is going to increase as we go ahead. So these were some of the overall findings. And now I will go into the deep dive study, the case study that we did for landscape of climate finance in Ethiopia. So similarly, what we found in Ethiopia is that the climate finance in Ethiopia must scale at least 15 times. In 2019 and 2020, the average tracked climate finance was around 1.7 billion. You can see this small circle in the slide here, which is 1.7 billion of that climate finance. But as opposed to that, Ethiopia's NDCs and national adaptation plans say that Ethiopia needs at least 25.3 billion per year from international climate finance need. So we can see what is the challenge that is ahead of us, and we need to act quickly to address this financing gap. Before I move on, I have a small question for you. Note down your answer in the chat box or in your notebooks if you are in the room. What do you think is the share of adaptation finance in the total track climate finance in Ethiopia? So the total finance will go towards adaptation and mitigation. So how much of this percentage do you think is going towards adaptation finance? I will give you a couple of minutes to think about it. I can also maybe check some responses in the chat. Do you think it is less than 10% at the moment? Do you think it is it is getting its due and it's almost of the total finance? Or do you think it's more than 50%? Okay, we are getting some responses in the chat. I think obviously it's less than 10%. Okay. So I'll tell you the answer now. It's actually 56%, which is a stark contrast compared to the global trends that we see. So globally, the share of adaptation finance is only 7%, and more than 90% goes to mitigation. Whereas in Ethiopia, we see that adaptation finance is dominating. And this is great because it is aligned with the climate vulnerability of the country. But of course, that does not mean that we are where we need to be. This slide here, you can see that in adaptation, it is about 0.95 billion, so $950 million per year are going in adaptation, whereas the needs are close to 4 billion per year. So we are nowhere close to where we need to be. We need to at least increase adaptation by finance by four times. And this is, we think, is an underestimation as well, because it's incredibly hard to estimate adaptation finance needs because of the data and methodological challenges. So we think that this 4 billion is in itself an underestimation. And you can see the climate finance gap is huge for mitigation. And mitigation is going to be very important for Ethiopia as it grows at the rate that it is growing. And we need to increase the energy access for Ethiopian people, and mitigation will be important as well. So you can see that even if there is a relative balance between adaptation and mitigation, we need to scale up both of these financing to at least 4 to 15 times. On this slide, what you can see is the split between private and public sources of finance. So the blue bar here is the international public financing, which dominates the current landscape of climate finance in Ethiopia. More than 88% comes from international public financing sources. The 91 million that you see is international private financing, and 44 million is domestic private finance. Currently, there is no system of climate budget tagging in Ethiopia. So there is no data publicly available on how much the government is spending on climate projects. So you'll see that there's a major data gap here in terms of domestic public climate finance. And if we further break it down, the breakdown of international public financiers by actors, you'll see that almost 50% of it comes from multilateral development banks, which channelize their funds to Ethiopia. And the second source is foreign governments, which fund climate finance projects in Ethiopia. So there is a lot of scope for increasing climate financing from private sectors and domestic public actors where private finance really lags. It's only 8% of the total climate finance. So uh, there's a huge opportunity here for private investments to be scaled up. In terms of the sectoral split, we see that in if compared to all other sectors, agriculture, forestry, and land use, the AFLU sector gets the most financing, which is 29%. Um, However, it is not, it is very less compared to what the contribution of blue sector is in emissions. So 83% of GHG emissions in Ethiopia comes from blue sector. So even if it is the largest sector getting climate finance right now, there is a lot that can be done to increase this financing. And we see that 35% goes to other and cross-sectoral solutions. So these are basically nexus solutions which provide both climate and development uh, benefits. There are co-benefits with sustainable development goals, which these solutions harness. So it's really important to critically link climate finance projects with other cross-sectoral solutions and break silos so that one particular sector doesn't get uh, just doesn't one particular sector doesn't get all the financing, but we break silos and improve coordination across sectors so that all sectors benefit from finance. Um, Having presented these findings and setting the baseline for what is the current status of climate finance in Ethiopia, uh, there are definitely challenges that Ethiopia is facing to scale up climate finance. So even if Ethiopia has progressed significantly in establishing policies, plans, and institutional frameworks to mainstream climate change into development planning at both national and subnational level, yet there are some regulations which limit its capacity to leverage resources effectively. So Ethiopia needs to build its financial and operational capacities so that it can improve vertical integration between national and subnational level. That will help to avoid any policy gaps and also sync up the national action plans with local initiatives. Beyond this, there are also some policy and regulatory barriers. We know that Ethiopia is a highly regulated financial market, and there are also unfavorable lending terms for smallholder farmers or sectors like off-grid solar, where government push and favorable policies are really important for scaling up. As I mentioned earlier, majority of the climate finance in Ethiopia is funded from public sources. So Ethiopia's financial sector is facing issues like foreign currency, lack of access to foreign currency. The loans are lack of access to loan, and that is affecting the growth of the private sector. There's a serious lack of bankable climate projects because of several issues like high risk, low return profiles. These can be actual risks or risk perceptions. There are the ticket sizes of projects are very small, so there are high transaction costs, and that really hinders any aggregation or securitization of projects. There are high interest rates for smallholder farmers or for system like if they have to buy irrigation systems or do any agri businesses, high interest rates really hinder them from taking loans and scaling up their business. And there is also a lack of risk mitigation solutions, so insurance or guarantees really help private sector to uh, get involved in these projects, but that is currently lacking. Having said that, of course, there are several steps that Ethiopia can take to expand investment in the coming decade, and I will talk about some of these solutions in the next slide. There are also some capacity and coordination barriers. So, lack of technical capacity, for example, there are knowledge gaps in financial analysis, proposal development for accessing climate finance from international agencies or multilateral climate funds. There is also limited awareness of climate science and risk analysis, which hinders private sector to incorporate these considerations in their investment decision making. There is also limited focus on disclosures and reporting structures for climate financial flows. So, this is applicable for both public and private sector, and this leads to inefficient decision making. There's also frequent structuring of staff and reshuffling of government staff, which leads to lack of buy-in from key policy actors and lack of development of any internal capacity within the government. So, a dedicated task force is really important when we talk about climate change. And to address all of these, there are definitely some opportunities and recommendations that Ethiopia can harness. So, the Ministry of Finance and the CRG facility can build a one-stop shop for publicly accessible and comprehensive knowledge management, so that it not only tracks climate relevant domestic expenditure by the government, but it should also track other public financing from other state-owned entities or philanthropies, NGOs, CSOs, and it should also track private financial flows. So this one-stop solution can really help identify what are the entry points for efficient use of not just public resources, which are very scarce, but also give investors an idea of how they should invest and where they should invest. So such a one, such a tracking mechanism can really bring transparency in the investment decision making in Ethiopia. There is definitely a role to play by development partners and development financial institutions. Development financial institutions can really play a role in investing some of the climate finance projects and develop blended finance by using their concessional loans. So that there is a scope for building blended finance instruments for risk sharing. Development partners can also help in capacity building and access and implementation. So currently, for example, there is only one designated entity which can access funds from the Green Climate Fund, but there is definitely scope for building capacity within other organizations so that more organizations can access climate funds from international sources. Financial sector actors like the National Bank of Ethiopia can enable policy and regulatory frameworks so that it can help accelerate private investments in the green economy. So some of the ways of doing that can be addressing foreign currency shortages, creating a favorable collateral policy, as I mentioned, for farmers and for small and medium enterprises. They're both suffering because of lack of access to credit finance. And there is need for attractive lending terms for microfinance institutions and use of innovative instruments like mobile banking services so that more farmers can access climate finance. There are many more actor-specific recommendations in the report, so I will suggest you all to take a look at the report, and I can only present a short summary here in the webinar, but the report really goes into the depth of what different actors can do to scale up climate finance. And before we wrap up, there is uh, a lot of climate financing action going on in different countries, and there are learnings from few countries that Ethiopia can harness and jointly develop best practices and enforce regulations. So, to give you an example, we worked with South Africa in the National Treasury of South Africa to understand the landscape of climate finance in 2020. And as a part of it, we worked with them to operationalize a climate budget tagging module. And now, building on this, South Africa's Presidential Climate Commission is following up with a 3-year program to scale up climate finance based on what the entry points are and where the gaps are, and really scale up investment in green economy and resilient economic growth. So, understanding this sort of landscape and understanding where the gaps are, opportunities are, can be a really good way to start the climate financing journey. And this is it's very important to note here that the CRG facility has already started working on this. There is a lot of institutional architecture that is being built. There are steps being taken for climate budget tagging. So we just need to harness this momentum and scale up financing. And in terms of innovative financial solutions, there is a serious need to mobilize private climate finance. And innovation is the key here, because we know that the business as usual is not really suitable at times for climate projects. And we need to be innovative in the way we structure the instrument or the financing architecture for climate projects. So the way CPI does this is through something called the Global Innovation Lab for Climate Finance, where we identify, develop, and launch innovative financial instruments that can drive billions of dollars in climate projects, especially in developing countries. So since the launch in 2014, we have worked on 55 different financial instruments and mobilized $3.2 billion in climate investments and with co-benefits for sustainable development. And I can give you an example of one of the instruments that we worked on in East Africa. So it's called a Climate Smart Lending Platform, which aims to bring together different tools, actors, and financial mechanisms so that climate risk can be incorporated in the credit rating system of banks' loan portfolio. So this once these negative externalities are internalized in the credit rating system, there is automatically an incentive for smallholder farmers to adopt climate climate smart agriculture. So it automatically sort of helps in scaling up climate finance. And this instrument is already in its scale up phase. It has already conducted 3 pilots across Africa, and it has a market potential of about $200 billion. So we can see the opportunity here is huge. We just need to think smart and think innovative and make sure different actors have with different risk appetites come together and um, develop a project that works for everyone. So I will stop here for now. I've thrown a lot of information at you, so happy to take any questions.
A few questions from online, but we're going to invite you for asking any questions to Raj as well. But I think I get priority to ask the first question since I'm up here. So Raj, one of the things that I found slightly troubling is we're still at over $2.2 trillion gap to reach our needs. And one of the things that I understand is that there's a lot of private sector capital in climate right now, over 1.5 trillion. So, what have been your findings of why that has not flowed in to Africa, and what can we do to get more of that attraction from the private sector?
So there are different things at play here. So especially in private finance, you can see that uh, the fundamental challenges of developing a climate project and developing an infrastructure project, for example, remain the same. So in developing countries, there are various risks, actual risks and perceived risks, which hinder private capital to make investments. For example, you can see that in like small scale farming or irrigation systems, agribusinesses, they have high investment risks due to issues like information asymmetry or capacity constraints. And these, they are not just there for climate projects. We need to sort of first lay a foundation that is conducive for private investments. And I think FSD Africa is doing a great job in that direction already. So other issues can also be like transaction costs, high transaction costs, because in developing countries the ticket sizes of projects are so small that the aggregation and securitization become quite difficult. So we need to sort of, as I mentioned, there's definitely a potential for huge private investment, but we need to be smart about what are we offering to the private investors and how do we structure our project in a way that it becomes viable for private investment.
My name is Ibrahim Zaidi. I am a former CEO of Comesa Monitoring based in Nairobi. I didn't hear the presenter to be mentioning debt for climate adaptation swap. Debt for climate adaptation swap is one of the most important areas to consider in climate finance. Did you try to identify projects which can benefit from this debt for climate adaptation swap? One of my questions. I will also come up with more questions later.
Yes, so I think it's about the use of debt for climate swaps, if I heard it correctly.
That's correct.
And it's a very an interesting question. Definitely, as I mentioned, innovation is the key here. I wouldn't say innovation is a key in a sense that it's a panacea for all our problems, because ultimately climate finance needs to be uh, the mainstream, and we need to sort of think about climate change impacts and climate risks in all investment and decision making. So, but right now to scale up, we can start with thinking innovatively, and debt for climate swaps is definitely an important area there, especially in countries in Africa and Asia where we see that climate finance is sort of adding to the debt burden of countries. Um, and for Ethiopia, currently we see that is not the case, because at least the finance that we track is mostly grant based. But that is an issue once we think about sustainable flow of investments and think about how we move away from just grant based systems. So debt for climate swaps is really important, and I think it is becoming more and more on the global agenda for climate finance as well. We have been hearing talks of international reforms in the multilateral development bank space, and make sure that the lending clauses for climate finance, or in general for lending clauses for international financing, take into account these disasters and climate risks. So I think it is very important, and I would say that it is gaining more and more traction now. Now that we're seeing evidence of how climate finance is adding to the debt burden of the countries. So um, there are some examples of successful implementation of debt for climate swaps, and I think definitely there are some learnings that Ethiopia can harness.
Great, thank you. So we have two questions from virtual participants, so I'll ask both of them to you so that you can hit two birds with one stone. First one is just a clarification for the audience, what the difference between climate finance and sustainability financing is. I think that's a really important thing that people should discern here. And then the second one comes back to some of the constraints around green economy projects that might be happening in Ethiopia, especially within the renewable space. And it seems like there are some constraints in financing. Did your case study find anything that indicates why that is and what we could do about it?
I can totally see that there is so much of jargon and terminologies that everything sort of starts to blur after a point. So, climate finance, green finance, sustainable finance, these are all terms which are sort of used interchangeably in the literature. But just to sort of give you a mental picture of where how the hierarchy works here is climate finance is just for climate mitigation and adaptation and any dual benefits projects. So the scope there is quite limited. When we talk about green finance, all the other environmental objectives like pollution or waste management, they also sort of get added to the climate finance domain. And then sustainable finance becomes the umbrella under which all of this can fall. So sustainable finance can be anything that any investment that we do for achieving the sustainable development goals. So that can then have a very broad range of outcomes and objectives. So this is the sort of hierarchy maybe that's useful to distinguish between these terms. And the second question about the constraints of financing and scale up. So, as I mentioned, public financing is already a majority or dominating source of climate finance right now, and the scale or like the constraints are mainly on the private side. And unless we sort of bring more private actors on board and offer them viable options, it's going to be hard to scale up climate finance just based on the scarce public resources that we have. So, for private investment, one of the ways we have seen can be carbon markets, for example. There is, of course, um, there are a lot of challenges globally that we are seeing with carbon markets of quality of the carbon credits and also the quantity of carbon credits. But definitely for developing countries, it's a very useful option to to scale up climate financing and also offer different like more jobs and livelihoods to the local communities. So, in terms of constraints, as I mentioned, there are risks that need to be mitigated. And one of the solutions can be the development finance institutions becoming playing a role of major enabler in the system because they have worked in different geographies, different sectors, and they've always had development as the core of their business. So there are so many learnings that they can share, and there's a scope for knowledge transfer there. So, and plus their use of concessional finance can really help in de-risking private investment. So there is, even if the development finance institutions are funding a large chunk of climate finance right now, they need to start thinking about what is the long-term strategy and what they can help the government to build a long-term climate finance strategy for Ethiopia.
All right, thank you so much. And really important to distinguish the hierarchy between climate, green, and sustainable financing. Yes, we have a question from the audience.
My name is Shmallis Saraya. I came from a financial sector. First of all, I want to thank you for your nice presentation, and it's a opening regarding climate finance issues when it comes to Ethiopia. How your research approach DFIs in Ethiopia, if they have this role accepted or emphasized not only at national level but globally. So how your research approach DFIs in Ethiopia, specifically the Development Bank of Ethiopia, which has been in operation for more than a century in the country to support development initiatives in high priority or priority areas of the government. That's it. Thank you very much.
Thank you. Raj, just so that you have an opportunity to address a few questions at once, I'll just see if there's anyone else in the room that has any questions. Yes, in the back.
Hi, my name is Aman from EIH. My question is regarding some of the financial barriers that you mentioned, specifically around sort of the small holder in the agriculture space or from a distributed renewable energy, and the high transaction costs that are related to that, given the small scale projects. Um, and I believe I heard you mention something about aggregation of these projects, and have there been any successful models that have aggregated these, either like in the securitization market or anything like that that we can refer to, and what has been the outcome in terms of reducing transaction costs there? Thank you.
Thank you.
I think they're all really important questions, and they're really pinpointing where the issues are. So, for the first question on the role of DFIs in climate finance, the gentleman mentioned some really important events that are going to happen in this year in the DFI space. There's going to be the MDB's spring meetings. There's going to be Financing Common Summit in September, and what we are hearing is the discourse right now is that how development finance institutions, and especially the MDBs, really unlock climate finance for developing countries, and especially the small island states which are at the forefront of the disastrous impacts of climate change. So even if MDBs are the largest source, in one way that shows what is their critical role in this entire landscape, but in a way that also shows that they they are the key enablers for bringing in more actors, because they have learned so much with from their experience in this space. So I would say there are two things that DFIs need to do right now. One is the de-risking. So because they have access to concessional capital, they need to really um, sort of increase their risk appetite and really be the anchor on which the private investments can invest in climate projects. So de-risking and blended finance instruments is where the DFIs have a really big role to play. And second would be, as I mentioned, the knowledge enablers, or enabling capacity and both technical and financial capacity at for the national, subnational actors and other private investors. So they play this dual role of actually increasing the investments and also building the capacity in the system. So we cannot definitely lose this agenda at the international forum, and we need to push um, MDBs more and more to do more in the space. So I'm completely, I echo the sentiments of the gentleman there, that DFIs are really important in this space, and public development banks in general. The second question was about data, and that is again a really important question, and that is where CPI has been uh, developing a very strong methodological rigor and data collection capacity over the last decade, because we understand how important data is in making efficient investment decisions. So I know that 56% is sort of uh, it can it can be shocking because that is not what we have been hearing globally. We have been hearing globally that adaptation is not receiving its due, and mitigation is sort of is the preferred theme for investment. But Ethiopian government, I think the CRG facility and Ministry of Finance has really done a lot in the national adaptation plans and in general in the policy space to push for adaptation. So I think that is sort of um, is seen in these investment trends. And I completely agree with you that the disbursement data is what is important. Ultimately, what is the impact and effectiveness of this climate finance and how it is um, ultimately having real impacts on the real economy is what is important. So, what we collect is commitments, at least we collect information at project level. So this is not, we are not considering secondary investment in this. So any sort of bonds or equity investment in companies where we don't know what the end use of proceed is not counted as climate finance in CPI's methodology. So that is our first filter of really only accounting for finance that is going to real economic projects. And secondly, there is honestly abysmal data right now on what the disbursements are. Whatever patchy data is available, it shows that only 10 to 15% sometimes is disbursed actually after the commitments are made. So I completely echo your sentiment that um, there needs to be a more effort from all actors to disclose the disbursement data so that organizations which are sort of playing a role of this data collection and understanding what the trends are, they can use that data. But currently, the disclosure mechanisms and reporting mechanisms don't really push for um, disbursement data. And I agree with you that going forward, that needs to be the focus of how the data is disclosed by investors. Um, and the third question was about aggregation and securitization. So, um, yes, there are um, out of the 55 instruments that I mentioned that have gone through the Global Innovation Lab for climate finance, there are various examples where uh, aggregation and securitization has worked for small scale farmers and for small distributed renewable energy projects. So I would definitely urge you to check the website, and there are examples from Kenya, and there are examples from South Africa, Indonesia, India, where uh, this sort of off-taker risk is mitigated, and securitization sort of through the use of mobile banking services, where the farmers can communicate with each other and with the finance providers. That sort of innovation is really helping bring together these small ticket sizes and help bring down the high transaction costs. So there are examples, and I would urge you to check the website.
Great. Thank you so much, Raj. So, like all good things have to come to an end, this is a very great presentation that you gave us, and unfortunately, we'll have to close it off here. But do download the report, do critique it. There are points of contact there that you can reach out with any questions and feedback. And based on some of the questions that we've heard, there's definitely a lot of valuable inputs for this audience to provide, and we'll highly encourage you to give that feedback to us. So with that, we're going to take a short break, and we'll reconvene for a panel discussion right afterwards. Thank you.
Thank you. It was a pleasure.